Okay, so for our next slide deck, we're going to talk about flexible budgets, standard costing, and variance analysis. So this is going to sort of pool together all the concepts that we've learned up to this point. Okay, so remember before in our last lecture, I was talking about the budget and how in accounting everything's a cycle, okay? Um, so in this particular case, we are performing what's called a variance analysis, all right? So we create this performance report to compare um, our budget to our actuals, okay? Or maybe we're just comparing, this year to last year. It really depends, okay? On what you're trying to figure out. But um, you make your comparison, you analyze the variances. So let's say you're comparing your actuals to your budget and you notice variances in the costs. Okay, well, why did we spend more than we expected to? So we drill down and we identify the root causes of that. And then we take action to try and adjust course, right? Um, Mitigate or eliminate those costs. And then we conduct a year's worth of operations, and then we prepare this performance report. Okay, so our planning budget. This is prepared for a single planned level of activity. Okay, um, it's difficult to assess differences um, between different levels of activity using this. Okay. So you're comparing these static planning budgets with actual costs, and it's not a good comparison. Okay. It's more simplified than what we did in the last chapter. Okay. This is looking at, um, your differences. Okay. Um, so a flexible budget is different from the static budget, okay? It's an estimate of what revenues and costs should have been given the level of activity, okay? So you can prepare these for any activity level, and they give you this apples to apples comparison, and it helps your managers to control their costs, okay? And you can in turn use these to evaluate your managers, all right? So first, we're going to look at the static planning budget to see what's wrong with it. And then we'll look at the alternative. So, in this example, Larry's lawn service provides lawn care in a planned community. All the lawns are the same size, okay? At the end of May, Larry prepares his June budget based on mowing 500 lawns. And since all the lawns are the same size, Larry felt like the number of lawns mowed would be the best way to measure overall activity. So here's his planning budget, okay? Number of lawns, 500. That's what his assumption, okay? Revenue at $75 per lawn is 37,500. Wages and salaries, there's a fixed component and a variable component. Okay, gas and supplies, equipment and maintenance, all these are based on the quantity, i.e. the number of lawns. Then office shop utilities looks like it's fixed. Office and shop rent also fixed. The depreciation on the equipment, not a cash outlay. Insurance and total expenses. He's expecting a net operating income of $5,000. Okay, this is, good start. So, what actually happened? Okay, he actually mowed 550 lawns and he received a revenue of $43,000. There's some expenses that came out of it, and at the end, he has net operating income of 6,450. Okay, well, that's definitely more, I mean, more is more income. He also did more work. So what does this tell us? Well, let's drill down and look at which items are favorable versus unfavorable. Okay, that's what these F's and U's are. Favorable is any time we make more money than we anticipated, or we spend less in costs than anticipated. Unfavorable is the opposite. Okay, so for revenue, we were expecting 43,000, sorry, planning budgets over here. We're expecting 37,500. Instead, we made 43,000. So that's a favorable variance. Okay, wages and salaries. We were expecting to only spend 20,000. We spent 23,500. Unfavorable. We spent more than we thought we would. Unfavorable variance in gasoline and supplies. Okay. We had a favorable variance in equipment maintenance. So even though we mowed more lawns, we did less in maintenance than we anticipated. Office and shop utilities also had a favorable result. Do you think this is affected by the number of lawns that we mowed? Probably not, right? Insurance, we paid $200 more in insurance. That's unfavorable. So our total expenses were unfavorable. Our net operating income, the variance was favorable. Okay. So since these variances here are unfavorable, does that mean he did a good job of controlling costs? We really can't tell, okay? Because the actual activity is different from what we planned. So the relevant question would be how much of the cost variances are due to higher activity and how much are due to cost control. Okay, so we have to use this flex budget in order to answer these questions. Okay, so remember back in the beginning when we first started talking about total costs and fixed costs. Okay, we know that variable costs are going to change in direct proportion to the activity, whereas fixed costs are going to stay unchanged within the relevant range. Okay, we learned that in the first week, second week, I think. Okay, so here's our flexible budget. Okay, in our flexible budget, we are anticipating mowing 550 lawns based on $75 per lawn. We expect to make $41,250. Okay, wages and salaries, all our other expenses, right? Our net operating income, we should be making $6,650. Okay, so we need to do two different calculations. First, we are going to compare the actual revenue to the flexible budget revenue. That difference is a revenue variance. We're going to compare our actual costs to our flexible budget costs. That difference is our spending variance. Okay. So we're going to use this flex budget to analyze the differences in costs. Okay. So number of lawns, our flexible budget versus our actual results. Okay. Same number of lawns in each. We are expecting revenue of 41,250. We actually got revenue of 43,000, so our revenue is favorable. Okay. Wages and salaries, we paid more than we budgeted, so that's unfavorable. Gasoline and supplies, more than what we anticipated, so that's unfavorable. Equipment and maintenance, less maintenance than we anticipated. We anticipated 1,650. We actually had 1,300, so that's favorable. office and shop utilities, okay? $50 less, so that's favorable. And then our insurance premium was unfavorable. Okay, our overall net operating income was unfavorable. We should have brought home at the end of the day 6,650. We only brought home 6,450. All right. So our total spending variance is unfavorable. Okay, let's say you've got more than one cost driver. Okay, so in that last example, we were just looking at number of lawns. Okay, so sometimes you need more than one cost driver to explain all the costs. Okay, cost formulas can be used for your flexible budget and can be adjusted to recognize multiple cost drivers. So in this example, Larry's Lawn Service will also provide an edging and trimming service to his customers at $30 per hour. He estimates that he will provide 100 hours of this service. Okay. The revenue earned from and time required for edging and trimming is different for different lawns. So Larry decided to add an additional cost driver, hours. Okay. So in this new budget, we just added a couple of things for the edging and trimming service. Okay. So number of lawns is designated with Q and the number of hours with H. So we are gonna mow 500 lawns, but we're only gonna do edging and trimming for 100 hours worth. Okay. We've got our 75 lawns and our $30 per hour for our trimming service. And then in wages and salaries, it costs us $25 per hour to provide that service. Okay. Again, this is our planning budget. All right. All right. Sorry about that. I went past our thing. Okay. So our flexible budget here includes our revenues, our expenses, including our fixed cost here at wages and salaries, total expenses of 37,100, net operating income of 7,150. Okay. Standard costs. Okay, standards or benchmarks are the norms for measuring your company's performance. Okay, so there are two types of benchmarks that we usually use in cost accounting. There's quality standards. They specify how much of an input should be used to make a product or provide a service. And then price standards specify how much should be paid for each unit of the input. And we'll see examples of that coming up. Okay. So when we set these direct materials standards, we have the standard quantity per unit. Okay, that's summarized in the bill of materials. This is your substantiating document. Okay, and then the standard price per unit. This is the final delivered cost of the materials, net of any discounts. Okay. All right. Then our direct labor standards. Okay, the standard hours per unit. Usually get this from time and motion studies for each labor operation. Okay, and then standard rate per hour. This is a single rate that's used to reflect a mix of wages. If you ever want an example of this, you could go to like the GSA website. Here they give you different wage rates for different job categories. And keep in mind that that wage rate represents the high and low, median, the average for that job description. Okay. Um, so we have a quantity standard. This quantity is the activity in the allocation base for the predetermined overhead. And then our price standard is the rate. This rate is the variable proportion of the predetermined overhead rate. Okay. So this is an example of a standard costing card. Um, if you remember, we kind of looked at something similar to this in the second week of class. So here you have the direct materials, the direct labor, our manufacturing overhead at our allocation rate, okay, and then the cost per unit for the item. Okay, so when we're trying to drill down on our spending variances, okay, we're going to be looking at the standard cost per unit for direct materials, direct labor, and variable manufacturing overhead to compute our spending variances, okay? But we can also break them down to look at price versus quantity variances, okay? So standard cost can be used to drill down into that spending variance and sort of piece it out into its price and quantity components. Okay, we'll look at that. All right. So again, on our variance analysis, we have our price variance and our quantity variance. The price variance is going to be the difference between the actual price and the standard price, and the quantity variance is the difference between the actual quantity and the standard quantity. Okay. So price and quantity, they're generally determined separately for two reasons. Okay. Different managers are usually responsible for buying and using inputs. Okay, so the purchasing manager is responsible for purchasing the raw materials, and the production manager is responsible for the quantity of raw materials that are used. All right. The buying and the using activities occur at different times. So raw material purchases may be held in inventory for a period of time before being used in production. Okay. So again, price variance, the materials price variance, the labor rate variance, and the VOH rate variance, all part of this. Quantity variance, the materials quantity, the labor efficiency variance, and the VOH efficiency variance. Okay. Now, this is the general model of how we compare these two. Okay. Or three different items. Okay. So actual quantity at actual price compared to the actual quantity at standard price gives us our price variance. If we take this actual quantity at standard price and compare it to standard quantity at standard price, we get the quality variance. And then both of these together constitute our spending variance. All right. This is just a visual model of what we're talking about. We will do an example. Okay. All right. So just to define these terms, in case the names are misleading in some way, actual quantity here is the amount of direct materials, direct labor, and variable manufacturing overhead that's actually used. Whereas the standard quantity is the standard quantity allowed for the actual output of the period. This is our benchmark, okay? Actual price is the amount that we actually paid for the input that we used. Whereas standard price is our benchmark price. Okay, it's the amount we should have paid. All right, so let's look at an example to clarify. Glacier Peak Outfitters has the following direct material standard for the fiber fill in its mountain parka. It uses 0.1 kilogram of fiber fill per parka at $5 per kilogram. Last month, 210 kilograms of fiber fill were purchased and used to make 2,000 parkas. The materials cost a total of $1,029. So, actual quantity times actual price. We had 210 kilograms at $4.90 per kilogram. So 1029, okay. Actual quantity times standard price. That's going to give us our price variance, okay? Comparing these two. So 210 kilograms, the actual quantity, times $5 per kilogram, the standard price, whoops, gives us 1,050. So our price variance, $21 favorable. Okay, the quantity variance, so how much of this polyfill we used, we're comparing this actual quantity times standard price times the standard quantity times standard price. That's 200 kilograms times $5, $1,000. We have $50 unfavorable. Okay, so if we compare this 21 favorable and 50 unfavorable, we get our total price variance. Okay. All right. Oops, went too far. Okay, we can get this same answer instead of going through that table that we did on the previous page. We can do this with an equation, materials price variance, actual quantity, actual price minus actual quantity times standard price. Okay, same with materials quantity variance. If the formula works better for you than the table, use this method. You get the exact same answer. Okay, it's just a matter of what works better in your brain. Okay, all right. So keep in mind that your materials quantity variance is the production manager's responsibility, and the materials price variance is the purchasing manager's responsibility. The standard price is used to compute the quantity variance so that the production manager is not held responsible for the purchasing manager's performance. Okay, so this is what your managers have to say. Okay, production manager, I'm not responsible for this unfavorable materials quantity variance. You purchased cheap materials, so my people had to use more of it. Your purchasing manager says your poor scheduling sometimes requires me to rush order materials at a higher price, causing unfavorable price variances. Okay, we're going to move past this concept check. Please feel free to work that on your own. And keep in mind that you can work that either as an equation or as a table, whichever does best for you. Okay. Next up, we're going to talk about labor variances. Okay, so we're back to Glacier Peak Outfitters. We have the following direct labor standard for its mountain parka. 1.2 standard hours per parka at $10 per hour. Last month, employees actually worked 2,500 hours at a total labor cost of $26,250 to make 2,000 parkas. Okay, actual hours times actual rate compared to actual hours times standard rate. Okay, 1,250 unfavorable. And then actual hours standard rate, standard hours standard rate, their efficiency variance also unfavorable. So they were paid too much and they did not work efficiently. Okay. Again, you can work the same equation, or the same problem. You can work this with an equation instead of working through a table, and you get the same answers. Okay. 1,250 unfavorable for the rate variance, 1,000 unfavorable for the efficiency variance. Okay? Your production manager, they are usually held accountable for labor variances because they are the ones who influence how skilled your workers are. They motivate your workers, they supervise, and they train your employees. So if they're not working efficiently, this is usually your go-to guy. We're going to talk next week about how to evaluate. But keep in mind, their areas of responsibility are going to come up when we talk about evaluations next week, because in order to be a meaningful evaluation, you've got to tailor those criteria to the actual job being done. Okay, again, pushback from your managers. Your maintenance manager says, I'm not responsible for the unfavorable labor efficiency variance. You purchased cheap materials, so it took more time to process it. And your purchasing manager says, I think it took more time to process the materials because the maintenance department has poorly maintained your equipment. Okay, again, we're going to swing past this concept check. Feel free to work that on your own. The slides, without me talking about them, are available under the weekly overview. Okay, next up, we're going to compute the variable manufacturing overhead rate and efficiency variances and explain their significance. Okay, so again, we're looking at this Glacier Peak Outfitters, and they have the following direct variable manufacturing overhead labor standard for its mountain parka. There's 1.2 standard hours per parka at $4 per hour. Last month, employees actually worked 2,500 hours to make 2,000 parkas. Actual variable manufacturing overhead for the month was 10,500. Okay, so we're going to compare again our table, actual hours by actual rate, is going to give us the rate variance when you compare it to actual hours by standard rate. Okay, $500 unfavorable. Then actual hours times standard rate times standard hours times standard rate. The difference between these gives us our efficiency variance, $400 unfavorable. Okay. Again, we can do this as, as a equation instead of as a table. Okay, same answer though. Passed our concept check. All right, materials variances. All right, the quantity variance is computed only on the quantity used in production. Okay, whereas the price variance is computed on the entire quantity that is purchased. Okay, it's a subtle distinction, but important. All right. So again, we're back to Glacier Peak Outfitters. They have the following direct material standard for the fiber fill in its mountain parka. 0.1 kilograms of fiber fill per parka at $5 per kilogram. Last month, 210 kilograms of fiber fill were purchased at a cost of $1,029. Glacier used 200 kilograms to make 2,000 parkas. Okay. So when you are looking at the price variance, you want to look at the quantity purchased, actual to actual price, actual quantity, or yeah, purchased to standard price. Okay, we're looking at purchased amounts here. And our price variance was $21 favorable. Then for our quantity variance, we don't care how much they bought. We only care how much we actually used. Okay. So for actual quantity used compared to standard quantity, standard price, standard price. Okay. Here we had a quantity variance of 0. that is the end of chapter 9. Thank you so much for listening in. Please feel free to reach out to me if you have any questions about anything. And good luck on your assignments. Um, please try to get those in sooner rather than later. It definitely makes my job a lot easier when it gets to the end of the semester.